Now, when it comes to financial assets, initial measurement. According to IFRS 9, financial assets are initially recognized at fair value. Recognized at fair value. Recognized at fair value, including transaction costs. Including transaction costs. Including transaction costs. Now add this statement to it. Unless classified as fair value through profit or loss. Unless classified as fair value through profit or loss. Unless classified as fair value through profit or loss. What does that mean? It means two statements are there you must understand. Number one, when it comes to financial assets, there are two ways we recognize financial assets. Number one, fair value through profit or loss. And then two, fair value through other comprehensive income. Let me explain that very well. When we say we are carrying financial assets through profit or loss, it means that any gain or loss on the financial asset is recognized where? In the profit or loss or in the income statement. When we say we are carrying a financial asset through other comprehensive income, it means any gain or loss is recognized where? In the other comprehensive income. I hope it makes sense, the difference. It doesn't.
It's not the same thing.
No. Fair value through P&L. Any gain or loss on the financial assets is recognized in the income statement or the profit or loss. Meaning before net profit. But when we recognize the financial asset at fair value through OCI, then any gain or loss will not go to the income statement, will go to other comprehensive income. Do you get the difference? You know there's a difference. The income statement itself ends at profit for the profit after tax. Then we come to OCI. Say you carry the financial asset through OCI, and the any gain or loss no, okay. But you carry through P&L, and the any gain or loss will be coming here.
Okay. Will the question be explanatory for you to know it's true OCI?
Yes, the question will be here. Sometimes they can tell you.
Okay.
Sometimes they can tell you.
If they don't tell you.
If they don't tell you, you can infer from the question. Okay. There are certain statements they will make that will trigger that, and we will be looking at those questions there.
Okay.
Now, when we recognize financial asset through profit or loss, it means that any transaction cost is written off in the income statement or in the profit or loss. Okay, I'm using these things interchangeably. It's the same thing. If we carry financial assets at fair value through P&L, then any transaction cost is what? Written off. Any transaction cost is written off. Alright, so that is the idea about that. But if it is fair value through profit or loss, then we don't write it off. It will be included in the assets, okay? It will be included. So here, transaction cost, it's included. Transaction cost is included in the initial cost. Transaction cost is included in the initial cost.
Transaction cost, like what? It's cost to sell transaction cost.
Here, issue costs.
Issue cost.
Commission to the broker.
Oh, okay.
Are you getting it? So the cost we incur in issuing the shares, in issuing the shares or in buying the shares, whatever it is, we are going to be, because it's a financial asset, it means we are the ones buying the shares. Are you getting the idea? We are the ones buying the shares. Then let's come to the opposite side of the coin, and that is financial liability. With financial liability, it's simple. Financial liability. With financial liability, it is initially recognized at fair value less transaction cost. We recognized at fair value less transaction cost. Meaning we subtract the transaction cost from the proceeds, and that becomes the value of what? It. That becomes the value of it. Then subsequently, any gain or loss is recognized through P&L. Is recognized through the profit or loss. It's recognized through profit or loss. No. Yes, it's a liability, and yes, it's a liability. So everything has to be dealt with in the income statement.
So in the liability, as the financial liability, what you said, commission to the broker, and all that, you less it from the fair value.
Yes. That is, it is an asset, right?
No, liability.
No. The first thing we did was an asset.
Yeah, that one you said you include it.
For assets, no, for assets you less. Look at it very well. This rule here is about still assets. And I said if it is carried through OCI, then you will include it.
Yes.
Are you getting it?
But if it's through P&L,
then you write it off, meaning you deduct it.
Okay.
You got it?
Yes. No, but in the notes you said initial measurements is recognized by including the transaction cost.
Or unless into that's two statements there, and I'm not breaking it down.
Okay.
Two statements there or say unless
Okay.
Into normally, because we think it is equity, it's normally carried at what? This one.
Okay.
Through OCI. Meaning the transaction cost to be included in the initial cost. So let's say we issue shares. Let's say a share is 2.5 and we issue 10,000 shares and we pay transaction cost of say 1,000. Now 2.5 times 10,000, that is going to give me somewhere around 25,000. So the issue cost is what? 1,000. Now if I'm carrying it through profit or loss, then I would what?
Subtract
from it. Are you getting it? Then, if I'm carrying it through OCI, I what? Add it to it. And we'll be looking at some questions right now, just to make these principles clear for you. Then the last thing is that, when it comes to financial liability, we always carry it using what? The amortized cost. If you remember what we did at the leases, it means you will do the schedule. But Ahano, you are not doing the schedule and separating it into current liability nor current liability. But you will still be doing what? The schedule. That is the amortized cost approach that you'll be using here. So two things. One, financial assets initially recognized at fair value unless it is treated through OCI. Financial liability, we recognize it at fair value less any transaction cost. Any gain or loss is what? Recognized in the profit or loss, but we carry the liability at what? The amortized cost. Now, if there is any derecognition of either financial asset or financial liability, any gain or loss is taken to the income statement. Okay? So if there is derecognition of either financial asset or financial liability, any gain or loss is taken to the income statement. So these are the things you have to understand about financial assets and financial liability.
Can you repeat your last statement?
If there is, or if the entity derecognizes a financial asset or financial liability, if an entity derecognizes financial asset or financial liability, the gain or loss is recognized in the income statement.
Derecognizing means what? They don't.
Meaning, if it is an asset, you sold it, like you sell the shares of. If it's a liability, you've paid the debt.
Okay.
The debt. So when you are paying the debt, any gain or loss will be recognized. If it is about shares, and you bought the shares for trading purposes, meaning through profit or loss, so whatever gain or loss, you have to recognize it in the income statement. When, in fact, the whole show. Hey, they just said the whole show.
From this part, the FV through PL.
Yeah.
And the FV through
OCI.
OCI. I understood, but which BB chair and I'm confused.
BB to say
You asked a question.
Oh, besides a question about transaction cost, and I may say, if you are carrying through fair value or fair value through OCI, no, meaning the transaction cost has to be what? Included. But so carrying it through profit or loss, it means the transaction cost has to be what? Written off. Oh, say, because it's an asset, you know, say, like this shares, let's say we're the one who bought it. What will be the double entry? We will debit financial assets or investment with how much? 25,000. Okay? And credit cash. 25,000. What do you mean? Now, assuming your shares, no, we bought it for trading purposes, then the transaction cost will be what? Written off. Are you getting the idea? So if it is being written off, what is the double entry then? We will debit the income statement with how much? The 1,000 that we paid, and what? Credit our cash with how much? The 1,000. But you see, say carrying through OCI, then this debit entry now can say call income statement, you know. Yeah, the bank financial asset, no. We would have debited what? The financial asset here. So that right now the financial asset would have been what? 26,000. Do you get it? That's why we say it is included. But here we write it off. Does it make sense? You okay now? Thanks God. So let's go to the questions we have there.